like no one's going to say this out loud, but
You're saying it out loud.
I'm saying it out loud. I get potentially in trouble for this. That I honestly think it's almost a little dirty secret within venture is that
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Today's guest once told me, every great conversation dances on the line of your understanding. You dance between both sides of the line trying to find out where what you know and what they know intersect and end. Good conversation is like play. This episode is our play. And since we get deep into his background and his life prior to being an LP, I'll keep my preamble intentionally short. Alex Felman is the general partner of the Felman Family Office, as well as podcaster, foodie, entrepreneur, including being the founder of Exponential U, where he dedicates his time educating next generation of family offices like himself on the venture asset class. From the toughest years of his life to how power laws affect venture firms even more than startups, to sharing things he might get in trouble for. Wink, wink. So this episode houses it all. So without further ado, Alex Felman. Alex, I've been really looking forward to this because we met under a very interesting context over a fund we were both involved in San Francisco. And since then I was like, okay, during that short interaction and then like the calls after, I realized I enjoyed so much of our conversations because it is not the I agree with you. It's actually, I think for the most part, where we dance along the lines of agreement and disagreement, and it's a really fun salsa dance in which we play. So I'm really excited for today.
no pleasures. I would say the pleasure's all mine. I've been looking forward to this as well. I think it's kind of funny because, like you said, we only met, what was this, in October, so maybe 2 months ago. But I think prior to that, because we were invested in the same fund, I think I had been looking at your content for probably at least a year prior to us meeting, something like that. And was actually like looking forward to being like, oh, it'd be nice to kind of meet this person in person. I've been, following especially your kind of LP musings of someone who, in a lot of ways, and I've started posting, kind of replying to things, said some ideas that I don't know, personally, for whatever reason, wasn't necessarily saying out loud, and kind of bringing to the surface things that are in the LP world that most people are kind of keeping in a black box and are keeping under control. And I really like this, let's say, bringing things to light that people, for whatever reason, let's say, put on pedestals or shudder away. And I think especially, there's been a shift in society overall that I think we used to have very, very kind of information silos. And with kind of the new digital world and the internet, like that world has pretty much disappeared, but it still kind of pops up in different areas. And people, I think people mentally in their behavior is slower to adapt to these things. And so people still, I think, operate mentally as if those silos still exist and there's still gatekeepers and all these things where in fact that does not exist. And I think that's a long-winded way of saying I really felt that some of the things you're saying from an LP perspective was bringing that to light, and it were either stuff that I had thought myself, or let's say were related to stuff that I thought myself, or was saying the quiet part out loud, and it was almost not exactly, but it reminded me of almost, let's say, something like putting out this reference, like a Kitchen Confidential for the LP world, if that reference makes sense.
Would never put myself in the same shoes as Anthony Bourdain, who is an absolute legend. Should we be eating while we're recording this? Is there a calorie deficit in your diet right now?
Well, it's I would say two things. On one side, you're talking to a really, really big foodie, so I might be making a whole bunch of food analogies or whatnot, and that's a big background of mine. But it's funny you say that because actually, let's see, so it's Thursday, I'm about to date this, Thursday the 11th in December, starting the 13th on Saturday, I'm actually about to do a calorie deficit diet for like about a month.
Wow.
So it is something that
is what you're actively thinking about.
A little bit, but this is actually something that I've been thinking about for like a while, and I'd say we haven't sort of gone into it, but I actually believe, like with my background from the family offices, I almost believe that like most family offices moving forward actually need like their own personal tastemaker or sommelier or whatnot, of actually someone who's like curating the world specifically for the needs of that family. And they're sort of taking the family's taste and then going out to the world and the market and being like, okay, our family really likes to do things in these ways. What funds or service providers or whatever events really match the family's profile? And I think just to survive the world, I think that's just the way you have to live moving forward, is just sort of like, hey, this is sort of the way that we do it. And not to say that you are not flexible with that, but you should be going out there with sort of like, hey, these are kind of the things that I really care about and whatnot. What are the things that fit into that? Because otherwise, I think if you're more kind of passive and whatnot, the sort of sea of information and knowledge is just going to get swept up in it.
Freaking love that you're using this analogy, and we're less than 10 minutes in and you're already dropping rap lyrics. The CIO, the family office principal, is like the sommelier here. But to double down on this food analogy, at what points do you think it's important to be adventurous with your taste? Like maybe like, is it 80% of the time you stick to, let's say, your spicy Italian, taste buds, but 20% of the time you try a new restaurant here or there? What is that allowable percentage of exploration?
I think it changes based on the person, right?
Mm-hmm.
I don't think there's any sort of specific thing that's like a one size fits all for all individuals. I think you're definitely right in the sense of you're going to need some amount of adventurous, some form of discovery, right? I honestly think you kind of go through almost cycles of this, of you'll go through cycles of, let's say, discovery, and then you'll go through cycles of, I'm not sure in this case, usually like when I would talk about that, you say like almost execution or kind of habits or routine or whatnot, right? And I think you go through cycles of like moments of where like, okay, I'm going to be discovering. And I think honestly, it's almost better to like build that in and go like, hey, on whatever frequency kind of works for you, go, I'm going to be in a moment of discovery now. But then also, because I always think, this is a slight tangent, right? I always think what gets people into trouble is when they're kind of using the wrong tool or trying to like do something, but for a different purpose. And I think that's where they end up getting in trouble of when they're sort of like, oh, I'm going to try to do discovery while I'm in my routine. Like, okay, you're probably going to run into problems. Or I'm trying to like routinize my discovery. Like those two things are almost in conflict with each other. Like, why not just like go like, okay, I'm discovering things right now, so I'm going to push my boundaries. I'm going to take a moment and go like, okay, I'm going to do a discovery phase. It's going to be this. The whole purpose of this is for me to learn new things and kind of expand. For looking at, let's say, sort of the double-edged sword of this, of like, I'm super high on the discovery side. Like my natural, let's say, rhythm is to like constantly be discovering and finding new things. And like to a certain extent with my like high level of openness, part of my personality is very much on going out to the world. But it's not just go out and find things in the world, but also for whatever reason, it's important for me to like synthesize them and then bring them to people and sort of it's almost I'm very, very into sort of like myths and storytelling and all this stuff, right? It's almost in a way a mini hero's journey, right? It's I'm going to go discover dragons or treasures. But I think one of the things that people always kind of forget, because I think people always, what they remember from the hero's journey is like, oh yeah, adventure, and we fight the dragon, we get the treasure or whatever. But the end of the hero's journey is always, you're supposed to bring that back to your community, and you're supposed to forward it to your community. And you're supposed to make your community better from the dragons or treasure that you fight or find. And I think most people, for whatever reason, like they leave off that last part, but I actually think that last part is extremely important. And I think, at least on some level, for me, I'd say the teaching side of my personality is very, very much tapped into that. And it's kind of funny because I think on some level I was always, even before I was a teacher, I was kind of always kind of that kind of person of I remember, I think this was probably either high school or college. I had a friend of mine who just like always liked talking to you because you were always kind of like knew what was going on and was always like coming up with like, oh yeah, I found this thing, let's go. I found this thing, let's go. And it was just sort of constantly discovering things, but constantly also being like, here's what I discovered, let's go do it, integrate it, make it kind of part of our life.
So fascinating. I think this actually bleeds quite interestingly to the homework I'd given you prior to this podcast. And you're the first person I've ever given homework to, in full transparency. But I asked you to draw a line. And I think this bleeds a lot into the narrative of Alex, that most people might not be familiar with. And we'll share the graph on screen as well. You have an interesting set of inflection points, specifically between the ages of 10 and 20. At least in the graph in which you drew.
Yeah.
There is an inflection downwards and a long plateau. Can you describe what happened during that period?
So I was able to see 9/11 from my high school. So I'm like an actual like close witness of it. But I think I very, very much so like had probably like serious PTSD from this, like in the sense of like I was having nightmares, I was having flashbacks. Like I feel like 9/11 was such an important event for so many people that when I say that like, oh, I was a witness and blah, 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 people, oh yeah, sure. But like to try to communicate, no, like I was in the middle of it and very, very close and close enough to like hear the sonic boom of the hit, close enough to feel the shockwave, close enough to like really, like I would say the thing that got me for such a long time was all the jumpers. Was something that was like imprinted into my brain of like, I was close enough to like see them.
Was it 100% introspective, or did you have conversations with people around you about the feelings and the internal dialogue you were having?
No. I would say 100% introspective.
Okay.
Pretty much. Now that I've seen the world like this, like, what does it mean? And I think I was almost forced to face some of the more like philosophical existential questions much, much earlier than a lot of people would have had to.
Right before the cusp of, say, 20 years old, at least in the lifeline in which you've drawn us, there was an inflection upwards. There was a period of time, and you say this is like 2-3 years, where you were introspecting, creating a story in your head. What helped you get out of that narrative?
It took like much, much longer than that, but I think actually the upward trajectory is, from what I was showing there, is essentially what I ended up doing. And we sort of talked about this, I guess, in the pre, or maybe you're going to insert that in, is when I ended up, so again, I grew up in New York, but then I ended up getting into Berkeley. I went to California, and that was kind of a whole different kind of shift in my life. And I think it was definitely kind of an overall kind of upshift. I think we'll bring this up again a little bit later, but I think I've always as well been, and maybe this is because of my high openness, but also, I'm not really sure what the other things, but I've always been somewhat anti-authoritarian, like anti-authority, and somewhat rebellious in that sense. And I found I really like Berkeley in the sense of that I felt you got all the same level of people that you might have had it, let's say, being from the East Coast, like in Ivy League or Stanford or whatever, but without the, like, I don't know, the same type of like elite stamp of approval that those types of places had. And I was always kind of very, I don't know. I was always very kind of, and probably still until this day, like trying to help people shatter their illusions around the sanctity of those types of institutions.
This I will come back. I promise we'll revisit the continuation of the story. So when you see in the, like, let's say as an LP or as an investor of any kind, and you see managers from the hallowed halls of, you name it, Ivies or Stanford, or you see they come from hallowed institutions, companies that are celebrated in the larger society, do you have an allergic reaction, even a mild allergic reaction to institutions like that?
Not necessarily.
Yeah.
But I will say that I often really want to see what they can actually do. And I don't necessarily, let's say, I think most of society takes those institutions and the stamps you get kind of from going through those institutions as an automatic, like, oh, that must mean they do good things. And I don't believe that. Not to say that there's not great people at all these places and so on and so forth, but I do think there is a certain, I think you're seeing this more and more, that tends to be more of a reflection of past performance and future performance. The game you play as you're building reputation becomes a different game than when you have reputation. And I tend to find from an LP's perspective, when you're building reputation, that's actually when you deliver the most value.
Yeah. Huh.
And that almost, to a certain extent, that once you have the reputation, in essence, what's going on there is that, not exactly, but almost that like you get rewarded as almost like a lifetime achievement award. That you get kind of after the fact rewarded for all the value you created while you're on the way up.
Yeah.
Because most likely while you're on the way up, you're actually getting undercompensated for the amount of value you've actually created. But once you have the reputation, then actually I think in most circumstances, you're actually kind of getting overcompensated for the actual value you provide. And you end up very much, and this is something that I kind of think about a lot.
Yeah.
Is that I very, very much want to avoid the sort of like, depending on which company you want to use, but the kind of no one gets fired for hiring IBM type of situation. Because I think the actual outcome of that tends to be very bad. I saw this before, but a recent post that you had was about the difference between owners and allocators. And I think, let's say if you have a family office where you've actually outsourced it, then your employee is more of an allocator than an owner. And in that case, that allocator, right, is often making decisions to save their own job or to ensure that they continue to have a job. But I find it slightly sad that ultimately, because of like almost like security and comfort reasons, things like people's pensions, which should be like more secure, are actually, in my opinion, taking riskier bets and bets that will lead to worse outcomes. And that's sort of the thing I think about a lot of these types of, especially if we're talking about like the big consultancies and so on and so forth. I think basically what it shows is it shows that you can play a very specific game.
Yeah.
And if I'm trying to do that same game, then great, or maybe. It maybe shows that you're good at playing games, so maybe that applies. But I actually think what you end up seeing is a lot of them end up being able to play a very, very certain type of game. And I, on the whole, I tend to find that at least as a private investor, that often doesn't lead to the best outcomes.
There's two things. One, I've had a couple conversations where sometimes at these large pensions, endowment foundations, they just don't have enough team members to cover venture. Like at one of the conversations I've had, I would say have to, but they have a budget to deploy $1 billion per year into privates.
Sure.
And in that case, I believe in that very particular endowment foundation, half of it into private equity, half of it into venture capital, which is actually quite a bolder strategy than most. So give or take like 500 into venture. They have a 2-person team who covers all of privates. And I mean, you know this because you cover venture yourself. A lot of covering venture, even emerging managers below a certain fund size, requires it to be a full-time job. Like you can't really have the opportunity to be distracted covering normally distributed asset classes, which is a different skill set.
On a certain level, I do agree with you, but I think there's a couple different things here. One, right, if you're having to do that, and I think this is one of the, let's say the issues, and I'm not really sure what the solution of this, right, is okay, if you're having to deploy, let's say $500 million into venture, into funds, right? It very much dictates what your strategy has to be. And very much so, let's say, one of the things that I believe in, and you can tell me if it's the same, I believe that, say, the amount of due diligence that you do doesn't matter depending on the deal size. So let's say as an example.
I agree.
Let's say if they're writing 5 $100 million checks compared to, let's say, $105 million checks, that is literally 20 times
20x.
the amount of work.
Yeah.
But I'm saying it's 20 times the amount of work to do that, right? And so even if, let's say that they would get a better return on that 100 into 5, like on a realistic level, that doesn't really, like it forces them to play certain types of games.
Yeah.
Right. So I think that's one of the issues that they have is that just from the nature of, let's say, what a pension fund is, basically requires them to play certain types of games. And again, this is where I see it as somewhat unfortunate. You can tell me if you're wrong, at least in my opinion. I tend to find with at least funds on the standard 2 and 20, that around somewhere, it's a little bit of a buffer, but somewhere around $75 to $100 million fund size is where the incentives shift from being carry oriented to management fee oriented. And basically, once you get in my opinion, once you get larger than that, then it actually becomes more incentivized for the fund managers to just build up their funds than the actual return itself. It's sort of, they're making so much money off management fees that like no one's going to say this out loud, but almost the carry becomes second. Let's say I'm saying it out loud. I get potentially in trouble for this. That I honestly think it's almost a little dirty secret within venture is that once you get above a certain size, you're making enough on an annual basis that like, oh, we're already making $2 million a year, or I don't know, $1 billion, we're making $20 million a year. Oh, carries a bonus on that, right? We could be very, very comfortable for our team. And then if you think about, let's say for a pension fund, that means the only funds that make sense for them are funds that are just incentivized to sell more. And where the carry is not as, and look, your GPs are going to argue with you otherwise, but I would argue realistically, it's just the incentives of the model of just, you're making so much money on an annual basis that the carry becomes a nice to have compared to when you're under that, the amount you're making on an annual basis, like, how would I put this? If you're a GP, let's say under $100 million, your management fees are probably giving you an okay life, probably an upper middle class life. But like, if you want any type of like long-term generational wealth, you kind of need to hit on the carry.
Yeah.
Whereas
I agree.
if you're above that, especially when you get to like $1 billion, you might be making generational wealth on the management fees by itself. If you're making I would argue, not everyone, like there are people who are, let's say, wired a bit differently. But I would argue most people, if you are making generational wealth just off your management fees, then the extra form of compensation is much more of a nice to have than a need to have.
What is generational wealth to you? Like at what point does it become generational? Like what number, roughly?
I think it's hard to say, but I would say if you could reasonably pass along, I don't know, changing a couple $1 million to your children, I think you have at least one generational wealth. I don't actually think the number is all that high, right? I think people actually overestimate the amount of money that they need and like future generations need. And I think in my opinion, I think this is one of the biggest reasons that families end up like over time, families end up losing their wealth is that those ideals don't get passed on. And so then you end up with generations that are consuming more than they produce. And if they consume more than they produce, then just realistically, I don't believe that you can kind of financially engineer your way out of a kind of overconsumption of your production, if that makes sense. Like if you're in a kind of ratio where your consumption is more than your production, I don't think you can do like financial wizardry and portfolio management out of that state. Yeah. I think you will just kind of lose that over time, is my personal opinion. And so I think you kind of need to stay entrepreneurial and you need to kind of just stay in a value creation mindset.
Yeah.
And state of being. If you want your wealth to continue through the generations.
Is that why you're actively running 2 companies? I think you've started 4 companies total so far, versus purely being a capital allocator where you're just investing family money. Is that why you take that approach?
I don't think, let's say I've taken that approach intentionally from like this strategic understanding. Mm-hmm. I think is a better way of framing it. It's not like I had this idea first and then I was like, oh, that means I should start companies.
Yeah.
I think it was much, much more so. And this is something that's really interesting is I don't think I was even like aware of this at the time. But my dad was always, so my dad's the one who started the family office, and growing up, he was kind of always entrepreneurial. And I think again, because we're talking like in my formative years, like the 90s and whatnot. So it wasn't the same part of the cultural zeitgeist that it became kind of in, 2010s-ish beginning is where I really think it became really part of the cultural zeitgeist. But for example, he was a lawyer, but owned his own law firm. And then he actually had to get out of law. And then he still started another company, which is a sports entertainment marketing company, which then kind of led to him starting Angel Group, which led to the family office and so on and so forth. And so I saw that, but like not from a like not from like the modern, like, oh, my dad's an entrepreneur and whatever. Just like, oh no, my dad has a company, right? It was just sort of like part of life.
Yeah.
And I think on a certain level, once I started to figure out, let's say, how I wanted to really make my mark on the world, it almost somehow naturally, I almost started to become entrepreneurial.
And at what point, because I believe you started getting more heavily involved in the family in 2014, why was that a period of time when you decided to get more involved?
Me deciding that is, I think, a very big stretch on how that happened. But let's back up a little bit of kind of what happened. So I moved to Brazil in 2011, and probably starting around then-ish, 2011, 2012, maybe even slightly earlier, but is when essentially my family started getting involved into like biotech, maybe 2010-ish. And they started to like drip feed me deals because, and I did mention this before, but I went to Berkeley and got a degree in molecular toxicology, which I want to say around 2010-ish, the family office started to get involved into biotech. Probably starting around 2011, 2012, they started kind of drip feeding me deals.
Yeah.
I don't know.
Why did they want to get involved in biotech outside of your background in it?
My family office has an interesting structure where we have our own personal family office as well as a multifamily advisory group where we're advising other family offices. And the family offices that we advise, we act almost like a corporate venture capital as a service. So the families we work with still have their family businesses, and we advise them on strategic transactions for their family businesses. And at least what I think more or less happened is we started to get families who had kind of health and medical backgrounds as clients. So they had like healthcare distribution companies, imaging centers, nursing homes, et cetera. Right. And so because of that, for the work we were doing for them, we started getting interested in like medical devices and biotech and so on and so forth. I would say it's almost when things kind of professionally clicked together. And that's what ended up leading. So from that and my experience there, I started to realize that essentially of the company, because I saw probably 2,000-3,000 companies in that first year, all in the biotech space.
Like all biotech,
and pretty much, yeah. And I realized like 80 to 90% of them were kind of disasters. And one of the things that I realized was one of the big reasons they were a disaster was essentially they were all being pushed by kind of the technical founder, so the researcher or inventor or whatnot, but were like really poorly structured as companies. And I realized that in something as technical as this, deep science is these types of companies, that you really needed kind of business people with science backgrounds. So people who had kind of again, I had a bachelor's level from a really good university, but a decent science foundation, but then someone who could then cross that over and do the more, business execution and that side of it. And I found myself fairly, not quite disillusioned, but kind of sad because I saw a number of companies that had like really, really good science. And it was very, very clear to me that they would never go anywhere. And it was just like, oh, especially if you're in the biotech space, right? These are like drugs that might save tens of millions of people. And because they don't know how to create companies, like those people won't be saved. Like that's kind of the trade-off there. And I found that to be just sad.
So fascinating. So you've gone on this journey, and there's a question that has been in my head, to be fair, since the day I met you. And there was something you said to me. I was like, that seems like it's well-founded, because in all of our conversations together, and I'm sure our listeners can understand the intellectual rigor that you have in your mind throughout every chapter of your journey, but you said something to me and I'm like, holy cow, I don't get it, but I'm sure there's more truth to it. But I've kind of been saving it till now to ask, which is when you're investing. And so you once told me this fascinating line, and I quote, "I write off every single sourcing slide on the pitch deck."
Pretty much. I would say that
if you'll allow me to dig deeper. Yeah.
I was going to say, to be honest, that is a slight hyperbole, but not a super big hyperbole.
Elaborate.
It's a slight hyperbole.
What are we missing here? What is the nuance we're missing here?
Okay. So the reason that I say that is a slight hyperbole is that I would say that's true in something like, 95% of the cases. It's not 100% of the cases, but it's like 95 plus. And I would say the reason that I do that for about 95 plus is that almost all those slides that I see are almost identical to each other. And in essence, and this is kind of related to, I don't even know how long ago this was, but the conversation we were having earlier about brands and reputation is, in essence, all those slides just become, in my opinion, a checkbox of brand name institutions, usually accelerators or universities. Could be other things, but it's usually accelerators or universities. And there's sort of a claim that like, oh yeah, we have special access to these big name kind of sources of deal flow. When you see kind of funds or opportunities on the scale that I see, then you start to realize that it becomes almost like a box checking exercise, that every fund sort of feels like they need to show that they have access to these kind of various reputational institutions.
Mm-hmm.
But a couple of things. One, if every fund has access to the same reputational institutions, there's nothing then special about it. I'll give you like a very, very specific example. I don't know if this is what you see, but this is at least what I see. I would say almost every fund manager that I see, at least let's say from a US fund, it's a little bit different, and you can kind of map this regionally, because let's say it does change a little bit regionally, but let's use US as a specific example. I would argue every, early-ish stage fund will say they get access from YC. Every single one. I almost compare, this might be funny, but and venture not always, but I would say most funds, right? At least for me, I don't know if you do this, but usually in most venture funds decks, on the first slide or two, there's usually a disclaimer for legal reasons.
Yeah.
And usually, at least me, usually it's always the same.
Yeah.
And I usually just, click buy it. I'm like, oh yeah, you have to do this. You check that box, it's legal, it's for compliance, blah, blah, blah. I almost see the source inside as equivalent to that slide.
To play my own devil's advocate, which is why I wouldn't put superclusters necessarily on us, like hypothetically, if I were to raise a fund, is because, let me ask you this. Alex, how many podcasts do you tune into on a weekly, monthly basis? Different kinds, unique kinds of podcast platforms.
My guess it's probably 10-ish on the podcasting side.
Great. So it's like, let's say, give or take 10, like round numbers, right? I am potentially, for some of them, 1 of 10 if I'm lucky. If I'm not lucky, I am 1 episode, not even the podcast. I'm 1 episode they tune into in a given year based on the number of views and subscribers or whatever I have, right? And because of all those things, I don't have proprietary access to anyone. Like hypothetically, if you're also listening to other investing podcasts, the chances is if you are a founder or you're a fund manager, you're probably going to have a conversation with them as well. It's like, I don't have proprietary access to deal flow per se. There might be some brand and reputation that's associated with this, to be fully transparent. But I think on the flip side, I couldn't count that as proprietary, much less having YC deal flow as proprietary. But I think there are certain corners of the world, and I think I have a very high bar for what like sourcing would look like. Most communities, most newsletters, most podcasts, including my own, are probably one of many that an average consumer is tuning into.
Even using the situation that you just said, and even if it's much less, I would imagine that, let's say, whatever size that is, that let's say whoever the people who, let's say, actually listen to the majority of your podcast, and I would imagine those people are an outsized number who are actually like talking to you, like directly. I would assume that. Like I would assume if you look at the Venn diagram of, you don't know, but let's say I would assume that, let's say, the Venn diagram of people who've listened to the majority of your podcasts and the people who've actually reached out to you because of the podcast overlap a lot.
Yeah.
Is the assumption that
I believe so.
Which basically means, right, that I would argue you've essentially nurtured a community yourself of, I would almost argue it doesn't even matter the size of that community. It could be 5 people, it could be 20 people, it could be 100 people. But I would say that that community that you've created by yourself, which is proprietary, like no one else has that exact mixture of people, and no one else has that direct relationship that you have with those people like you do, gives you at least some kind of advantage within that network that no one else can take from you. And that's my of whatever you want to say, it leads to this many inbounds and this and this and this and this is, but that is something that compared to, let's say, what you're probably seeing on the other side is that, I don't know, if you put YC on the deck, it means you've attended YC's demo day. Okay, cool. Like I just think that those two are, for me, fundamentally different things. And if you think about if you think about like proprietary as almost ownership, you own your community much, much, much more so than like that person owns the YC relationship.
That's fair.
I would say that those two things are not even comparable, in my opinion.
Going back to the equation you had earlier, which is for family offices, but I want to correlate that with the discussion we're having now, which is production versus consumption. Like if you're just going to YC Demo Day, you're a consumer of that type of content, right? Versus if you host your own events, you host your own content. Like despite, there's a bunch of smokes and mirrors here, but like despite that, you are still a producer of something. And that value, hopefully, assuming it's helpful, accrues over time, no matter how quickly it accrues. I will say on the YC thread, there are a couple different versions. I'm curious if you've seen this as well. A couple different versions of YC as a sourcing mechanism. One is the most we see is I show up to YC Demo Day, which means absolutely nothing. Like I can show up to YC Demo Day. You can show up to YC Demo Day. It means nothing, right? Second of which is they get access to YC pre-Demo Day. Or I forget what the exact term is, but there's like a pre-Demo Day to the Demo Day. And that is particularly allowed for a small subset of close-ish relationships that YC has. Again, not the end-all be-all, but for the most part, you're not buying into a 30 mil post round. You have access at ground game of like, hey, this is to build up momentum for people who are actually like 80% committed by the time YC Demo Day happens. And then there's like, I forget the nomenclature for this, but there's like YC pre-Demo Day. That's like a small, very, very small selection of mostly larger funds, like large multi-stage funds, have access to seed effectively a lot of the best founders that are coming out of the program. And then there is, we send companies to YC, like we help companies get in YC. And I think that's another layer of, even if you're not investing in them, there's a bit of trust that's built in the early days. And I think there's different layers to the YC thing, although I do agree in aggregate, YC as a sourcing mechanism is not what you should put on your front page slide.
I think my point was more so, as like even breaking it down in the way you just described it.
Yeah.
When I see it on decks, they're not even breaking it down themselves like that, which I would say most likely means they're at the we show up at Demo Day days. What I tend to see is almost all those slides look the same. Like for me, when I see that, they almost seem copy pasted. Like they almost look like they've been copy pasted. And at least in my opinion, if that's what I see, I'm assuming it's the last case, which is like the least valuable case. It is what I would assume is the default. And which is why I pretty much write it off almost always.
And I think that's a fair assumption. If they only have a logo on there without additional context, the likelihood of them just showing up at Demo Day is equally true for like any of the other like accelerator demo days like out there, right? Question for you though, if you effectively write off the sourcing slide as you do the legal disclaimer slide, what are the slides that usually catch your attention when you're reading a deck?
I would say, let's put it like this, because the way that I often see this, and we tend to focus a lot more on like emerging managers. And for stuff we talked about earlier of sort of, I think you might understand why, is we think that's where the real kind of value and upside is. We think you're getting people when they're hungry, but I think one of the really big things as well is, at least for us in the way we're thinking, is we want fund managers, or actually let's back up for a second. I would argue that emerging managers are basically investment startups. They're fund startups.
Capital entrepreneurs.
The capital entrepreneurs, exactly, right? And as and I would argue for any type of investment for an entrepreneur, what you really want to see, in my opinion, is do they have some kind of insight about the area that they're building their product or service, for a way for them to actually stand out within the market. So I personally want like a hyper specialist who shows that, like, usually within the first couple of slides, that, oh, you're showing me that you know something that is very, very unique, that, to your point, proprietary, that like kind of only you can know because of whatever. And if you're not really showing me that like you can really, really stand out, and at least for us, like we're probably only investing into 1 to 2 funds a year on the venture side. So we're basically, I'm probably seeing close to 1,000 funds a year. So I'm looking at like, what is the best fund I see this year? Like that's pretty much like what I'm looking for. And I would argue like, if you can't show me that like you can really, really stand out, then what's the point? Like what game are we really playing here? Because I think the other thing people don't realize from like an LP perspective is I would almost argue, like people are somewhat familiar with the power laws.
Yeah.
I would almost argue the power laws apply even more to funds than they do to startups. And if you really look at the data, what the data basically shows is that only, like if you look at the numbers, right? And we can get into this. So the benchmark for, I would argue, for a successful venture fund tends to be 3x.
Yeah.
And just to like update the market of why that is essentially over 10 years, if you do 3x, then kind of while also calculating in fees, then you're essentially on par with the S&P 500. Because the S&P 500 will give you kind of 8 to 10%. You compound that over 10 years, calculate in the fees, you end up getting about 3x is kind of the way the math works, right? So for a private investor, in terms of, let's say, like opportunity cost, if this investment is like not really doing better than the S&P 500 from a purely financial point of view, there's other things that we can talk about and we can get into that in a second. But for a purely financial point of view, if you're not doing better than the S&P 500, like why am I paying you extra to do worse than something I can basically get for free?
Yeah.
As like a baseline investment.
Yeah.
Right. And if you start to think of this as a startup, you start to think like, hey, I want you to be adding value to me from a financial kind of investment point of view. And as a benchmark, like 3x is kind of, I would argue, the bare minimum for you to be considered doing your job is my personal opinion on it. From those reasons.
Right.
What the market shows is that 5% of funds clear that benchmark. 5%. Which basically, like in my opinion, basically means like 95% don't. Like essentially 95% are like not doing their job, in my opinion, like are like underperforming doing their job. And so I think this is a bit of a question of like, okay, for you to have a chance to really stand out and outperform, then you need to be doing something not necessarily different, but like at least interesting, right? Like you need to be doing something compelling, interesting. You need to, like, why are you not part of the 95%? That would be that I might as well just put my money in the regular stock market. That's sort of what I'm looking for when I go through this. And so just really just trying to understand, okay, how are you different? What is your conviction? I would say honestly, unfortunately, like not a lot of fund managers have it. Almost the way that I say it, you have this intersection of, let's say, venture as a product or service meets venture as a job career. And I think there's a lot of fund managers who see venture as a job career and essentially want to use it as a way to get a paycheck. And because of that, they're going to put out a fairly boilerplate fund in whatever area. And it just sort of becomes, at least in my opinion, fairly uninteresting.
Yeah.
Of just like, no, ultimately this should drive value and not just be sort of essentially a way to move capital from one person to a different person on the whole. That being said, I think this is because I do like advise emerging managers and angels and so on and so forth. One of the things I do think, and I don't think enough emerging managers like lean into this enough, is I do think there's an argument around actually if you have high conviction on something and you are trying to drive a specific industry or cause or whatever, that you can claim that actually, okay, maybe we'll also make financial value, but we can actually drive a lot of emotional value. And that your return on investment is actually along the lines of other forms of value. And that it's actually like almost a more honest way of selling your product or service, of using a very, very simple example of like, I don't know, we're going to have a fund of cancer treatments. So anyone who really cares about solving cancer, come invest in us with a cancer treatment. Yes, we'll also try to get return on this as a fund, but we can guarantee that we're going to push the curing of cancer forward.
Yeah.
Like that is a service that we can promise and ensure that will be upheld. And I almost argue, this is probably a fairly contrarian point of view, is I would almost argue that, and this is going to be under my definition, I would argue actually many venture funds are basically scams under this definition.
Yeah.
I believe it's a scam if you knowingly sell something that you know you can't deliver on. And I think the dirty secret in venture is that if you purely look at venture from financial point of view, most fund managers know they can't hit their targets.
Yeah.
And yet they still sell that promise anyways. And I think that starts to become kind of scammy. And this is why I think
I hate it when GPs have on their slides, I have a target return of 7x, and it's all like purely hypothetical.
I mean, most of what I see is just sort of target returns of like 3, but of just sort
3
of
is realistic.
It's 3 because that's.
But to me, like the target return is a boilerplate thing too, right? It's like everyone's going to say no one's going to say I'm a target return of like 1.5x. They're not going to say that. And so it's boilerplate. And so it's actually what the fund construction model looks like, which is the actual Excel sheet.
No, I agree with you because that like in essence like needs to be the target and needs to be like the minimum benchmark. But it is also on an industry level more aspirational than actually like executional.
Well, I agree.
And if you look, I think to your point, if I'm not mistaken, I think the actual like average is somewhere around like 1.5, something 1.5, 1.7.
Oh yeah, like I forget where I saw this study, but it was like 60% of funds actually return less than 1x. And so the median actually gets really close to like 1.5, give or take. To be fair, top quartile isn't even inspiring for most vintages. Top decile might not even be most inspiring for most vintages. Like you really have to go to like the top 5% where it actually starts to make sense to be investing in venture as an asset class.
Yes, and that's sort of that's a bit more of my point is I feel like if we're looking at from a purely financial asset class, I would almost argue it becomes slightly scammy because I would argue the industry kind of knows that it's presenting a product and service that it actually can't really deliver on, but is selling it anyways. And I think that's an uncomfortable truth. Whereas to my point before is I actually think if you have eye conviction and start to push like, hey, yes, we're aiming for the returns, but we're also trying to push forward XYZ. And there's a tons of different XYZ things that it could be. I actually think that more funds can actually deliver on that promise than the financial promise.
And so, I mean, the way you framed is the financial motivation as well as the strategic motivation. I often say like it's the venture is both an asset class and an access class. And in many ways, you need both, right? Like if it's pure asset class, there is a world where it works out. A lot of it is luck-based. You probably underwrite I've seen a lot of people underwrite emerging managers to a 4 or 5x kind of thing. But anything north of that, you just can't underwrite. It's like very luck-driven. And across 3 vintages, you are more likely than not to get to a 3x, right? And so I've seen many funds where first fund is 8x, second fund 2.5, third fund 5. Like, there's no consistency of returns just because how luck-driven this industry is.
I agree with you. One thing I would add or that I think is slightly different is I actually see, and this is almost tied into what I'm thinking on the family office side, is I believe that like increasingly we're going to have more and more family offices that have a more like purpose around what their family office is doing. And so if you start to see the fund as a vehicle for you to help push your purpose forward, then it's a much different product or service, right? And this is where I'm sort of talking about, and I frame it as kind of emotional value of you've decided that these types of things are important for you to progress in whatever progress means for you. And then a fund can be a really, really good way to essentially allocate resources into that area, right? And so you're kind of paying someone to help allocate resources into an area that has high emotional value for you. And that's a much different, in my opinion, that's a much different product or service and relationship than I think most standard GP-LP relationships are. And I would personally argue, and this might be contrarian, is I would argue that's actually a much more like honest and fair relationship for both sides, where it's much more likely that both sides will get what they want. And so I would actually, like one of the things that I like suggest to emerging managers is actually like find what that thing is for you, to be unique and stand for something and have like what would be your fund where you're an N of 1 that like no one else, like what is your fund where you're an N of 1 and then find the people who really care about that and have won. And like, that'll be a good match just for like everyone involved. And that's how I often think about it. And I think it's kind of funny because we're still like somewhat investing and so on and so forth. Like I said, we do like 1 to 2 a year. On a weird level, I almost feel like I'm a optimistic cynic, and in a way, like I'm actually like overall extremely optimistic and positive about this, while being extremely cynical of the incentives and the actual stuff that's being sold, which is, I feel like, a really interesting thing in tension. But I think one of the reasons, this is maybe a different aside, is that on a very, very fundamental level, I think tech is one of the best places to be, because at a fundamental level, investing in tech is basically investing in human ingenuity and humans' ability to solve problems. That is like fundamentally what is, in my opinion, what is going on here, is that founders around the world are trying to solve and using human ingenuity to solve problems, and essentially make the world better in some domain. And so just like to push assets to do that, to me, what else would you want to do with like your resources? And you sort of find the specific, let's say, domains that you really care about and want to push forward.
So, Alex, man, I could go on forever and ever with you, and we knew we were gonna go down this rabbit hole and many more. But I'm not keeping you till 8:30 in the morning because it is getting later on your side of the world. So I have one last question, kind of on the theme of optimistic cynic, if I might put it that way. There's a really great quote from The Office that I really like, which is, "I wish there was a way to know you're in the good old days before you've left them." And so the question to you was, with all the doom and gloom in the world and all the cynicism that could exist in our world today, what are reminders you keep close to your heart that remind you that we're still in the good old days?
So many things about the world have been progressing that I think you can't help be excited. I think the simplest thing, we mentioned this before, the cost and effort to create something is becoming almost zero.
Yeah.
I think that might be one of the most amazing things in the world. Like, just the most amazing thing is that your ability to create stuff now is unmatched at any point in time. And the democratization of that, of nothing is stopping you from creating except yourself at this point in time. Like no money, it just, if you want something to exist in the world, you can will it into the world at such a low cost of resources that we've never seen in the history of humanity. I think that in and of itself is probably worth it. But also, like, I'm a big, I'm going to start doing in these terms. I think moving forward, people will talk about bits or talking about atoms.
Yeah.
I'm a big atoms person. Coming from kind of the life sciences side, I'm a big atoms person. And just what we're going to start, I really think like the next 20, 30 years in the more like deep tech, physical, robotics, biotech, food tech, etc., is going to be what the last couple decades were in the digital tech space. And I think, in essence, digital tech has opened up all these things that we can now do in the physical world, in a way that we haven't been able to before. And I think that is really, really exciting. I think the other thing as well is that I think it's being timed really well, because I think actually people are starting to get sick of how focused their life is in the digital world.
Yeah.
And so we're ready for kind of the counter movement of being more in the physical world. And I think the progress in technology is at a moment to facilitate that. And so I think that is extremely exciting. One thing that I'm thinking about now a lot, which may or may not be exciting, but it's something I think about, is, so I think two things are happening simultaneously. And I think what it might lead to is the next form of economics and the economy. So this is going to be another, I'm only going to touch base on it, but this could be a whole other podcast in itself. I do actually believe we've like gotten to late stage capitalism. Like I believe that. What I don't think about, but what I'm optimistic of, is right now, for whatever reason, we're trying old ideas, but we're not trying to come up with new ideas of how to structure an economy. And I think what's going to happen is, I think that what you're starting to see right now is you're starting to see the US dollar decline as the world's reserve currency. And I think when we pair that with the job loss to AI, it's probably going to break capitalism like for good. Like I don't think capitalism as a system will survive that, which will also be quite chaotic. And I'm kind of, say, the optimistic side of me is kind of yada a couple things that'll be very messy, but I think we're going to get to the other side of that and come up with some kind of new type of economy. And I think there's going to be an interesting opportunity there. And one of the things that I think about, like, not really as part of my day job, but of stuff that's like in my mind a lot of like, what does a next economic system look like?
Yeah.
And what are the lessons that we learned from capitalism and socialism and the things so far? Because I think that's the problem where the conversation is now, is we're taking the systems that were designed for industrial systems and trying to apply them to a more post-digital world. But we actually need a fundamentally new economic system for the post-digital world. And I, at least from what I see, I don't think anyone's having that conversation. I don't think we're having sort of intellectuals thinking about, hey, if we were to come up with a new economic system that takes the strengths of the old system and evolves them in a new way that matches the current and future economy, what would that look like? And that's something that I think in the long run, I actually am quite optimistic about, because I think one of the things, touching on a slightly earlier point around like knowledge and information, is I think our old economy was much more based around scarcity and whatnot. And I think the new economy is much more based around abundance.
Yeah.
And so I think we need to come up with a new economic system that builds in the principles of abundance to that system, at least on a digital level. But I think that will really, really start to play out in the physical world as well. I think we're not actually all that far. This is getting a little bit sci-fi. I don't think we're actually all that far, for example, like turning all our like landfills into sources of like atoms for like manipulation of atoms, right? Of almost, let's say, like molecular 3D printers or stuff like that, right?
Yeah.
And if once stuff like that starts to happen, all of a sudden, like a lot of our sustainability issues completely change, right? It's sort of like all these things that like we have as waste sitting in all these parts of the world, all of a sudden we can then like completely reuse them and then like reintegrate them into society. It is I think, a real game changer for just how we use stuff in the world.
That's amazing. Alex, I can't imagine a better place to end on than with where the future can go. And if people aren't having the conversations of what the next economic system could look like and what a world of abundance would look like, and I'm sure that those people are having some here and there, hopefully this episode will inspire people to have more of those conversations. So thank you so much.
No, David, thank you. And would be more than happy to do this kind of whenever you want, if you think it's, I feel like from what you sent me, we touched on a handful of things, and happy to do this again.
I think we touched on less than 10% of the things that I sent your
probably.
way.
Probably.
But that's the beauty of conversation. Conversation is like play.
Yes.
And
yes.
Alex, thank you so much. For all the Superclusters fans listening, we'll see you soon.
I don't remember if I told you the story when I was at San Francisco. Did I tell you about when I saw Dave Chappelle?
No,
I
don't think so. I don't think so.
Okay. Because he was like really the first. I feel like I sort of kind of knew this, but this is, I saw him. This is in 2008, so I saw him like a week or two before the Obama election. He had like just come back from Africa and whatnot. And in essence, this is great. I'm gonna try to do a shortest version of the story because this could take 10, 15 minutes by itself. But short version of the story, he was popping up in SF. I was going to Berkeley at the time. He was popping up in SF. I saw it. I had a bunch of friends who were big fans. They even created we had this thing at Berkeley called decals. They created a decals about the Chappelle show, and then like what it talked about race. Yeah.
Okay.
So a bunch of us, like 10 to 12 of us went, we saw it. I put it out, I was like, hey, let's go. And in essence, he had 2 shows, an early show and a late show. I was like, let's go to the late show because there's like no back end. Late show started at like, I don't know, 12:31. He had 2 hours of material, and then 2 hours after that 2 hours of material, he goes, all right, now's when the fun part starts. He goes, I'm going to try to break you, and you're going to try to break me, and we're going to see who's going to break first, and proceeded to do 6 more hours. So he finished at like 8:30 in the morning. And it became this game of like, do I go home and go to sleep, or do I wait for the next Chappelle? And literally what those 6 hours was him pacing the stage, like searching for funny. And there literally would be like, I don't know, 10 minutes of him just pacing, like not even saying a word. And then he would it almost seemed like he was pulling something from the air. It almost felt like he was pulling inspiration from the air. And it literally just became this game of like, because I would say every, I don't know, 15, 20 minutes, you'd get like, again, this is where I think about it. You get like a gem, or he would just say random stuff, and he was just searching. And then all of a sudden he would say this gem. And so it became this game of, do I stay up for the next gem, or do I go home? And it just became this thing. And that's something that stuck with me of this analogy of just like, no, it's about, essentially it's almost like luck surface area. It's about giving yourself as much space for good things to happen. And that's sort of what I see sort of with the podcast, right? Is just record this long form content. If you record, and because if you don't record it, you don't have it, right? So you can't have it. But if you record enough of it, then there will be things there. And I would argue you'll find good stuff, right? And
I agree.
Most of it probably won't be good or useful or whatever, but there'll probably be a handful of really, really good things sprinkled throughout there. And I don't think you actually know what those things are. And I would almost argue, like from a certain extent, you're not even the right person to tell what those things are. It's sort of the customers are. Like, it's like other people will tell you what's really good.
You might not
right?
be the end consumer.
Yes, exactly. Right. And so it's almost just like taking lots of shots on goal, right?
Sometimes you don't know what is good content because you might not be the end customer, end consumer of it. But even when you are, how often do we ever have a conversation and we think to ourselves, damn, I wish I recorded that. I wish we had a mic in front of the 2 of us. And oftentimes it isn't, right? Because it's not being recorded. I'm not saying you should record every part of your life, and maybe granola is helping with recording every part of your life. But there is a world where some of the best ideas you have are unscripted. Actually, probably most of the best ideas you have are probably unscripted in nature, but that leads you down a rabbit hole in a very interesting way.
No, 100%. I think this ties to, right? I think we were talking about this on the last call we had, right? I think your really good conversations are essentially play. And we had this conversation around that, right? And I think that's why they become unscripted, right? Is when you're with, let's say, friends or good people that you know, you're having like a really interesting conversation. It's often unscripted because it's often a form of play. And going into, we mentioned this on our last call, I think really, really good play straddles the line of comfort and stepping outside your comfort zone, right? And I think really good things happen when you cross that line. And so you might not even be, let's say, aware that let's say this gem or whatever you want to call it was even going to be discussed, right? But because you start to play with these ideas and debate them and explore them, all of a sudden you, let's say, might get insights or understand things in a way that you never got it before, or you bring in, let's say, because you bring in different people whose understanding of the world is different than your own, all of a sudden they bring something of their understanding into the world, and it opens up something from your understanding of the world, right? And I think that's where a lot of the really cool stuff happens is by, different people sharing and connecting from the different parts of the world that they're able to see. And that essentially opens up, by coming together, you both then see more. And it essentially expands your worldview.
It's actually funny that you bring that up. I literally have, like what we talked about last time, it was such a good line, that good conversation is like play. I have it sitting next to me right now. And if I were to quote the exact line that you said in our last conversation, it goes along the lines of, every great conversation dances on the line of your understanding, and you dance between both sides of that line, trying to find out what you know and what they know intersect and end. This is inspired by Jordan Peterson. Good conversation is like play.
What do I do?
It was such a great line. And speaking of, like, we weren't recording anything during that catch-up call. But I was like, dude, this is so good. And I wrote that down when we last chatted. Hey, Superclusters fans, you made it past the snap and you didn't disappear yet. So I have a mini message for you. If you enjoyed today's episode, if I might be so bold, I have 2 favors to ask of you. 1, there's a big red subscribe button if you're on YouTube, and if you want more of what you heard today, that's the magic button. 2, I know every single one of you knows something that I don't and has a question I've never thought to ever ask. So I'd love to hear your thoughts and curiosities down in the comments. So the next time you tune in, you hear the answers to the questions that you would like to know. I promised myself I'd record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more meaningful and helpful to you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I want to share a quick disclaimer. The views here and expressed in this podcast are for informational and educational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we are a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. So consult a professional investment advisor prior to making any investment decisions. That's it for me, but if you want more, this left video is what we think you'll also like, and this right one is our latest one if you haven't seen it yet.